Hello everyone, my name is Khalid Hamid. In this video, I'm going to share with you my presentation during Traders Fair Malaysia 30th June 2018 with the title, The Best Way to Make Money in Forex. This is the trading book that I have authored, which is called TFS Price Action Trading. I'm going to tell you more about it later. Let's go straight to the introduction. For those who doesn't know me, my name is Khalid Hamid. I've been trading for the past 11 years since 2007. I'm the author of a book called Teknik Forex Sebenar, which in English means the real Forex technique. It took me 2 years to complete this trading book, starting from 2009 until 2011. And for the past 7 years, from 2011 until 2018, it has been one of the most popular trading guide in Malaysia. But this year, I decided that I'm going to rebrand, and we changed the brand to TFS Price Action Trading because it is more specific, which tells everyone that we teach price action trading. Besides price action trading, we also taught about money management, how to control your emotions during trading, trade management, and many other topics inside it. And since before this, we have the word Forex inside the brand, we decided to take it out because whatever taught in the book can be used in any other markets like stocks trading or maybe even gold or commodities, and also crude palm oil, and you just name it, whatever market can be applied. I'm one of the most followed trader in Malaysia with over 33,000 followings. I got a page with close to 107,000 likes or followings. And also, I have a YouTube channel with more than 8,000 subscribers. If you want to find out more about me or TFS Price Action Trading, you can just search this keyword or my name, Khalid Hamid, or Teknik Forex Sebenar in Google. Besides writing a book, I also taught people all across Malaysia. And these are some of the photos of me teaching them. So let me tell you something about Forex trading. Forex trading is like riding a motorcycle. It's risky, but doesn't mean that everybody get involved in an accident. You can control your risk by wearing a helmet, taking care of the maintenance of the motorcycle, and lots more. So by that, you can get a lot of benefits or rewards by controlling your risk. Next, it's also like driving. When you first drive, you don't know how to flick the switch, where's the pedal, where's the brake, how to give signal, and lots more stuff that you don't know when you are driving for the first time. But as the years goes on, and you gain more experience in driving, you'll be better at it, and you might even drive while using your mobile phone. But please don't do that, okay? And it's also like losing weight. Everybody knows that to lose weight, you just need to do two things, which are to control your diet and you need to work out. But you have to do it. Anyone else can't do it for you. You can get the best fitness trainer in the world to coach you, but at the end of the day, you have to do it. Then only you get the result. Forex trading is also like that. And to lose weight, it takes time. You don't expect to jog 5 kilometers today and expect to lose 5 kgs tomorrow. Am I right? You need to control your diet and work out consistently for a period of maybe 3 to 6 months, then only you can see a result. And lastly, it's like planting a tree. You need to water it every day, you need to fertilize it consistently, and for a period of maybe 3 to 5 years, then only you get the result that you desire. You don't plant a tree and expect it to give you result in a short period of time, maybe like 3 months or even 1 week, like that. It takes time to get this kind of result. And once your tree reach to this level, you don't need to fertilize it or water it anymore. It will grow and keep on producing the rewards or the fruits consistently forever. So Forex trading is like riding a motorcycle, it's like driving. It's like losing weight, and also it's like planting a tree. You got that? Good. So let's move on. There are only two elements you need to control if you want to be a successful trader. First one is what we call as technical and fundamental analysis. Second part is risk management. And once you control both, you'll get to control your emotions. Why are you emotional when you trade? It's only because you didn't control one of these elements. If you control these two, your emotions won't be a problem. And in this presentation, I'm going to tell you how. So again, there's no rocket science. You only need to take care of your technical and fundamental part and also your risk management part. And your emotions will be automatically controlled. There are three truths in trading. The first truth in trading, perfect strategy doesn't exist. Regardless of your strategy, there's no one strategy in this world that can guarantee you 100% win all the time. There are times when you will win and there are times when you will lose. It's part and parcel of trading. So in trading, they say there's no holy grail. There's no strategy that can't avoid you from losses. So please live with it. Secondly, we can't win all the time. Like I said, there's time when you profit and there's time when you will suffer losses. And lastly, the market doesn't care about you. If you suffer losses, nobody's gonna cry for you. And if you make profit, nobody's gonna cheer for you. And you know that even if your capital is $100,000, you can't control the market. That's why I said here, the market doesn't care about you. So please stop thinking that the market will follow your trade. If you buy, doesn't mean that the price will go up for you. And when you sell, doesn't mean that it will go down for you. Even if your capital is $1 million, you are still very small in a $5 trillion market. Alright? Now let's move on to technical analysis basics and strategies. This is where the fun begins. So does this look familiar to you? A trader who keeps on losing until it reaches a stage where each of the position lost over 500 pips and the total is 3,227 pips. So what happened? This is what usually happens. A trader in an uptrend keeps on selling and hoping that the price will go down. And if it doesn't, they didn't set a stop loss, then they will keep on adding on position and eventually this is what happens. By right, on an uptrend, you should be buying when the price make a retracement and then you keep on buying on an uptrend and not try to stop the rocket from keep going up. So the first lesson you will learn is add on positions when you are running on a profit, not when you're suffering with losses. So if I ask you what is the probability or chances that your loss here will become a profit, and my answer was 0. There's no chance that from 500 pips or 3000 pips of losses will become a profit. Even if it does, maybe it will take 1 or 2 years. So please stop trading like this and always put a maximum risk that you are willing to bear in all your trades. So what's your trading objectives? It's very simple. You just want to make money, correct? So when you look at a chart, you are looking for decisions. There are 3 main decisions, which are, first one is whether you want to buy, second one is sell, or the third one is whether you are not going to trade. So buy, sell, or no trade. That's the decision you're looking for whenever you look at a chart to do your analysis. So putting it in a picture, you're planning to buy here or sell here on every turn of the market. It's very simple. So are you going to buy or sell? When you buy, don't forget it can go down, and when you sell, don't forget it can go up. If I ask 100 people whether they are going to buy or sell in this situation when this candlestick has already closed, you'll be surprised that maybe around 30% will say buy, 30% will say sell, and the balance 40% will tell you they don't know or no trade. So what I'm saying is there's always a 50-50 chance that the price can go up or down, and it's always fair. There's no such thing as confirm that this market is going up. What you need to do is you need to find your reasons to buy or your reasons to sell. It doesn't matter whether you buy or sell, because like I said, you're not the only one in the world who think that the market is going up. But what are your reasons? So if you find that the reasons to buy outweigh your reasons to sell, so you know that you'll be making a decision to buy in this situation. Now I'm going to give you the best of the best tips. A very quick one, but a very meaningful ones. So the first one will start off with the best time to trade. So the best time to trade according to Malaysia time is from 4 p.m. up to around 12 or 1 a.m. These are four of the largest financial market in the world. So you can see that when New York session starts, then only the market will become volatile and fast moving. And I'm going to prove it to you. So this is how a typical Euro USD H4 chart. For example, I'll give you one example here. From 4 a.m., these are all Malaysian time. It only moved 10 pips in 4 hours. So even if you buy at the bottom and sell at the top, you are only making 10 pips in 4 hours. When you compare, if the price moves during the active hours after 4 p.m., it can move 47 pips within 4 hours. So you can see there's vast difference when you trade the right time and also the wrong time. If you decide to trade in the morning of Malaysian time, you should choose pairs like AUD or NZD pairs. It's because their market is open in the morning. But if you ask me, you just focus on the US time, which is after 8 p.m. is the best time. So you just focus on that. Besides that, usually office hours end at around 6 p.m. So you got a break for 2 hours before you start trading at 8 p.m. So that's one of the advantage when you stay in a Southeast Asian part where you trade when the office hour already ends. So remember, the time frame you need to use, I really encourage you to just use a daily and a H4 chart, because these time frames usually won't give you a false signal. If you use a lower time frame than this, it bounds to give you a lot of false signals. False signals means it can be giving you a buy signal, but actually the market after that goes further down. But on a daily and H4 time frames, it rarely happens. So what are the best days? From Tuesday to Friday. The best pairs, just focus on these 4 pairs, because according to my 11 years of experience, these are the 4 pairs where you can make money easier compared to cross pairs and also exotic pairs. If you don't believe me, you can try it yourself, okay? So do you know that different broker can give you a different signal? I'm attaching here 2 samples where here you can see a sell signal because it rejects the big round number. And here you can see a bullish rejection signal. It signals you to buy, whereas this one it signals you to sell. So if you use a broker that closes 8 a.m. Malaysia time, you'll get profit in this trade. But if you use a different broker, it can give you a false signal and you will lose here. So my verdict is very simple. 8 a.m. close time gives you a better and more reliable signal compared to other times. And so far I know only 2 brokers have this, which are FX Citizen and also FXCM AU. There might be other brokers, so you need to check on that. So these are the testimonial we received about this lesson. This is in Bahasa Malaysia, so I've already translated. So it says, I've tried FX Citizen chart and find the chart really accurate. I used other charts before, not bad, but there's some candlesticks that doesn't touch on my support and resistance levels. So not only myself notice about this, but our traders also notice about this. So it's something that's already proven. So if before this you use a different broker, you might want to try this broker or any other broker that stops their daily chart at 8 a.m. Moving on, now we're going to the next lesson, which is wait till it closes. stop playing guessing game. Once it's closed, the direction will become clearer. In this example, you can see that the candle hasn't yet closed, and if you make a decision based on this movement, if you buy here, this is what happens after that, where the price suddenly make a rejection and start to go down. If you wait till it closes here, then you might sell after that and make a profit from here. So you can see that once it's closed, it can never goes anywhere else. So as you can see here, when you make a decision based on what has already stopped, the chances of you succeeding is far greater compared if you guess what it's gonna be or what it's gonna close as. When I say wait till it closes, means that whatever time frame you're using, for example H4 or 4 hours, so you need to wait every 4 hours and look at the chart every 4 hours. So once it's closed every 4 hours, then only you look at the chart, what is the pattern that it becomes. If it doesn't close yet, you won't know whether it will close as what pattern. If you're using daily, means that you check the chart every 24 hours. If it's H1 or 1 hour, you will need to check the chart every 1 hour for trading signals. So don't forget, always wait till it closes according to your time frame. Now I'm going to tell you a bit about candlesticks anatomy. It's going to be the basic of candlestick. So why do you see a green or red candlesticks on your chart? If it's green, means that it closed higher than the open. For example, it starts at 8 AM and at 12 PM after 4 hours, it becomes green because it closed at a higher price compared to its open price. If it's a red, it opens at the top and closes at the bottom. The lower shadow and the upper shadow shows the power of rejection by the buyers and also by the sellers. So these are the sellers area who sell at top or the buyers who exit their position. Those buyers who buy from the bottom, eventually when the price rises, they will close their position to take profit. Long upper shadow shows a strong seller because when you sell, you are going to sell at top and hoping that the price will go down. The opposite is true for the lower shadow. If you see a candlestick like this shows a strong bullish power because the rejection is strong. Remember, lower shadow is a signal of buyers. And the rejection, you can say there's no rejection by the sellers. The close price is same as their high. So this is high and this is the low. And this is true for bearish. If you see this signal, most probably the price tends to going further up. This is also the same for the signal, where it shows you a very strong reversal. At first, the price goes down, and after that, the buyer sets in and brings the price to the top. And if it closes like this pattern, then the tendency it goes up will be stronger. So just remember, if there's no rejection at the top area, shows that the buyers are strong, and the same is true if the lower shadow is long like this, and the opposite is for sellers. It's a selling signal. Simple as that. So in this situation, would you buy or sell? Always study the pattern. For example, you see this last candle when you look at the chart. Just imagine it's 8 PM at night, Malaysia time. So you try to analyze it. Opens at the bottom and it closes at the top. And this candle closes at a higher price compared to the previous candles. In other words, the candle eats 1, 2, 3, 4, 5, 6, 7, 8. 8 candles behind it. When you see this, you know that the buyer starts to kick in and the price probably will be going up. Once you already identified the direction, so you know that the price is going up, so you're going to buy. And this is what happens after that. So that's how you do an analysis whether to buy or sell. But next, I'm going to tell you where you need to place your order. So actually there are another two signals here. It's similar to this. where you see the buyer starts getting stronger, so you will target to buy. So after learning about the basic of candlesticks, now I'm going to show you two strategies that are very simple where you can follow. First one is what we call as the BRN levels, which are the 100 pips interval of price. So this is the example where you can see on the line of 1.3100 up to 1.3300. Every time the price goes to that area, most of the time the price will go to the opposite direction. It can be permanently or it can be just for a short time. For example, here price goes down, touch the BRN and goes up until the next BRN. So it goes like this. The red boxes are where it almost touches the BRN and not yet touch the BRN. The concept is like this. This is the BRN line. Most of the time when the price hits the BRN for the first time, it tends to go down. And if it does penetrate, usually it will go back to the BRN before continuing its direction. This is for bearish movement. So how do you identify or get the BRN? It's very simple. You look at the current price. For example, here is 1.3079. So you remove the last 2 or 3 digits. If 5 decimals, then it's 3 digits. So the first BRN will be 1.3200. And the second one, 1.3300. And lastly, the third one is 1.3100, which are 100 pips above and below. This is an example where you sell at the BRN. The price goes down, penetrates the BRN, and then it goes back up at the BRN level before continuing further down. If you are drawing at a chart, I'm going to show you later how to set is that you set it at the parameters. Now I'm going to show you in practical how to draw the BRN lines. First, you need to have a look at the current price. This is the current price, 111.46. So like I've mentioned, you just omit the last 2 digits, which is 46, and you will put the first BRN at 111.00. So you can change at the horizontal line by right-clicking it and change at the parameters to 111.00. So you have the first one, then you can draw the second ones. You can just drag it manually, but it's very hard to get a precise number. I would prefer to set it at parameters like this. And you need to have another one at the bottom at 110.0. Alright, that's it. If you want to adjust, make sure you double click first. The white dots will appear, then only you can right click. If I were to draw another line at 113.00, so you can see that if you look at the lower time frame, the price hovers at 113 and then it starts to plunge down a few hundred pips. You can draw BRN at any time frame, but I prefer to draw it at the daily time frame. So what's going to happen next is very simple. You just wait. The price goes here or down. If it goes down, so you will target to buy at this area. If it goes up, so at this area, you need to wait for the opportunity to sell it back. Alright, that's it. So always watch out for your BRN levels. The next strategy I'm going to share is the best reversal signals, which are the bullish and the bearish engulfing. The difference between the A grade and the B grade is the first grade closes above the high or closes below the low of the previous candlesticks, while the B grade only closes above the open or close below the open. So it doesn't close above the high or the low. So this is the difference of them. So how do you trade the signal? When you see the signal, what you need to do is very simple. You place your buy or sell orders half from the body of the candlestick and set your stop loss or your maximum risk at the bottom of the low of the candlesticks. Or if it's a sell signal, you set it on top of the highs of the candlesticks. Maximum risk I usually put is between 30 to 50 pips. This is so that it's not so hard for you to get a double reward from your risk. I'll explain later. But for now, you just need to know, just set your buy entry or sell entry half from the engulfing body. These are some of the examples. Quite recent actually. I just explained to you one signal. So this is a bearish engulfing, where it engulfs the previous bullish candle. So you will set your sell entry here. Price goes up, trigger your entry here before it goes back down. And it doesn't reach your stop loss if your stop loss is above the high. That's why it's important for you to put the stop loss above high or below the low. And this is another example where it's a bullish engulfing, it's a bullish signal. So you will just set your buy entry half of the body or the side, half of the size of the candlestick. You can choose it either way. And the price goes back down until the half body before it goes back up. This is also what we call as a 50% retracement entry. So it's look very simple, it's very easy to understand, but it's very powerful and can generate a lot of profits. So that's all about the strategies that I shared during Traders Fair. I believe it's enough if you're just gonna get started with Forex trading. Now we head on to the second element, which is capital and risk management. So remember the diagram with the two eyes, a nose and a mouth, which is in motion. So this is the second element, which is risk management. The first rule, don't risk more than 3% per trade, because if you risk more, you will lose more. So I give you an example of 10 straight losses. If you just risk 3%, you just lost around 26% and you still have a 74% balance. Compared to if you risk 10%, you will only end up with 35% balance after 10 straight losses. But usually this won't happen. What will happen for most traders, the first 3 trades, they might be following the rule. But starting the 4th trade, they will start to take bigger risks by increasing their number of lots because they want to break even quickly. So please don't do that. Another reason why you need to risk only 3% is so that you know if you suffer losses, it's not hard for you to get back your capital or break even. If you already lose 10% in 3 trades, that's already close to 30%, and you need to profit another 30% just to break even. And it's not that easy. So usually if you're taking a lot of risk, the first 3 trades, you lose 10% each, but starting the 4th trade, you will definitely increase your lot size so that you can break even quickly. So if you want to avoid that, just don't risk more than 3% of your capital. And always monitor your risk to reward ratio. You just need 4 wins out of 10 trades to get a net profit. You can get 6% if you trade 10 trades per week. So imagine if it's consistent every week, in a month you'll be earning 24% per month. That's really great, and that's a lot. That's why I always say you don't need to win in all your trades. You just need a minimum of 4 profits or 4 winning trades. And if you suffer 6 losses, you still can get net profit of 60 pips. However, the golden rule is you need to win at least double than your risk. That's why I put here, you only risk 30 pips, and when you profit, you get 60 pips. And imagine if you trade 10 times, doesn't need to be consecutive. It can be an interval like this. You still can end up with profit given if your profit is twice than your losses. So this is one of the key ingredients if you want to become successful in trading. So just imagine this is only 40% win. If you manage to get 50% wins every week, it will be 15% or 60% per month. So just imagine the potential of it if you manage to control your win ratio as well as your risk to reward ratio. The main point is this: you don't need to win in all your trades, and if you lose even half of your trades, you still can end up with profit. So please don't get emotional, don't get carried away by losses are the end of the world. So it's not true. You can't win all the time, like I said, and there's no perfect strategies in the world. What you need to do is you just make sure that your profit is more than your losses. So this is the subject on 5% monthly and compounding. Here's the return of some of the financial instruments where you can find in Malaysia or even in the world. So saving account will give you roughly around 1% per year, fixed deposit almost 4%, and unit trust, depending on the market, you can get maybe around 10 to 50% per annum on average. So if you compound even 3% or 5% per month, it can give you a lot of return. So this is an example that I have calculated. If you're consistent 10% for a period of 2 years, from 1,000 it can grow up to 9,850. Not that much, it's only 10% per month. So you don't need to try to get 100% per month, because most of the time I've seen a lot of traders achieve that. Of the past 7 years I'm teaching, most of them are because of beginner's luck. That's it. It's not consistent. Maybe out of 100 people, less than 5 people get that. So you want to achieve something that's more realistic, like this. So the main important point here is you need to give time. You can't get it in a short time. If you want it in a short time, most definitely you will fail. If you're using a Microsoft Excel, you can use this formula to create your own plan. So if you are trading with 1,000, you earn 20% per month for a period of 12 months or 1 year, you will end up with 8,916. These are all mathematics and numbers don't lie. I'm sure you know about it. What's important is that you follow the plan. Alright? So why do a lot of traders fail? According to statistics, the failure rate is 95%. So there's only 5% traders who are successful in the world. One of the reasons is because they over leverage their account. These are the example where if you would leverage 100 and 500. The main difference is this, which is the maximum lot size you can trade. If your leverage is 100, the maximum is only 1 lot. But if your leverage is 500, the maximum you can trade is 5 lots. That means the peak value is $1 compared to $5. So if you lose just 20 pips, here you will lose $20. But here, 20 pips times $5 is already $100. So you're losing the whole of your capital. And here, after one time loss, you still end up with $80. You still can trade. But here, you will end up with nothing. But actually, this is just an example. You're not supposed to trade this way, because like I said, after one time loss, you should still left with $97, which is 3%. This is just an example. So it's important for you to use a low leverage, because it can help you to stop yourself from damaging your account. When you trade and you are suffering with losses, it's very hard for you to control yourself. So you need a tool to help you to control yourself, which is by using a low leverage. The leverage that I recommend is 50 to 100 to 1. That's all. You don't use 500 or even 1,000 to 1. If you do, you will be blowing out your account very quickly. Simple. Max leverage 100 to 1 only. Okay? And use sufficient capital. You need to be realistic. For example, using a capital of 100, if you get 30% ROI or profit, how much will your profit be? It's only $30. You can't expect to get 1,000 by earning 30% from $100. What if your capital is 10,000? That means you are earning $3,000, which is 100 times more than what you earn with a $100 capital. So how to make big money using small amount of capital? What do most traders do? This is what they do. They over leverage their account so that they can trade bigger lots. Because when you use a high leverage, you can trade bigger lots with a small amount of capital. However, if you suffer losses, your account will be wiped out. You just need to remember, less funds, less profit. More funds, you get more profits. The bigger your capital, the bigger your profits. Please don't ever forget about this. So you just want to make a consistent profit between 10 to 30% per month over a period of maybe 1 to 3 years. Then you will get a lot of profit and a lot of money. Not only that, as the time goes by, as you know, you'll be more experienced, you'll get better at it, and only time will tell that one day you will make it finally. But please don't take a short time, don't take a shortcut. The shortcut won't bring you anywhere. You just need to stay focused, keep on trading, keep on learning, keep on improving your skills, and monitor yourself with a period of 6 to 12 months. Remember, if you risk only 3% per trade, it will take you 33 straight losses for you to blow your account or finish your capital. That won't happen. Usually what happens is because the trader starts to overtrade by using bigger lot size. That's why they blow their account quickly. If you follow the rule, you will survive for a longer time, and by surviving for a longer period of time, you're definitely getting good at it day by day. If you can't even control $100, don't bother using 1,000. Be realistic. You will need to start with knowledge, then you go to demo account, and then you use a small capital before going further with a bigger capital. Most traders, they do it the opposite way. They will start with a bigger capital, and once they lose a lot, it will become a smaller capital, and once they finish everything, they will trade demo account, and if they still can't make money on the demo account, then only they look for knowledge. So you need to do it the opposite way. Start with knowledge, you start with a demo account. Once you're consistent, you use a smaller capital, which is like around 50 to 100. And once you're consistent with that, then only you can use a bigger capital. And what I taught so far is only based on percentage. Whether you're using $100 or even $10,000 of capital, the risk management method is always the same because it goes by percentage. Alright, now is the last part, which is the emotions and psychology in trading. So actually, this part is not much because once you control your technical fundamental and your risk management, your emotions will be steady. So these are just additional tips. First one, set realistic expectation. Forex is not a place where you can make a lot of money in a short period of time. You need to aim for long-term consistency. Set realistic expectation like what I've shown you before. You have to have certainty. Use your stop loss. Don't ever trade without a limit on your risk. When I say here have certainty, means that if you trade with a 3% risk or stop loss, you close your terminal. Even without checking your terminal, you know that there's only 3 probability. The first one, it already hits your stop loss at 3%. The second one, it might be still running but on a losses. However, it still haven't reached your stop loss. That's the second probability. And the third probability is that it might be running on profit. So if you have certainty where you already know in advance what's going to happen to your trade, so you won't feel emotional. You only feel emotional when you don't have a limit to your risk. So you always wonder what's happening to your position or trades. When you have certainty, you'll get peace of mind. Stay away from your chart. I believe that the less you look at your chart, the more profit you will make. In my course, TFS Price Action Trading, I always stress about this, and I said you need to earn more by trading less, not earn less by trading more. I always believe in quality over quantity. You need to be really selective in your trades. Like I mentioned before, you need to take a trade that have a potential of giving you a risk to reward ratio of 1/2 at least. To achieve that kind of precision, you can't just simply take any trades that you see. You really need to drill down and make a good analysis. Then only you manage to get a high quality setup. Next, you need to have a second or third income. I always encourage people, don't be a full-time trader. You still can trade even if you have a steady job. Like I said, in Malaysia or Southeast Asia, your office hours stops at 6 p.m. and the market only moves a lot starting 8 p.m. onwards. So there's no need for you to quit your job because you want to become a full-time trader. Like I mentioned, the market only moves above 8 p.m. So if you quit your job, what are you gonna do? So most people, when they are bored, they got no job because they are full-time trader, and that's when they started to do a lot of mistakes in their trades. By having a second or third income, it will give you a better peace of mind because you know that you don't have to depend your life on your trading income. And lastly, keep away from noise. Noise here refers to Facebook signals, or WhatsApp group or Telegram group signals. When you already did your analysis, sometimes these kind of noises will affect your confidence when you trade. Always remember that when you trade, it's always you that determines whether you want to take the trade, whether you want to buy or sell, or even if you don't want to trade. It always depends on you. Nobody will tell you what to do. If you like to follow other people's signals, if you are suffering losses, they are not going to refund you back. It's always about you. You are the one who makes the trade. You will suffer if you lost, and you are the ones gonna be happy if you profit. Nobody knows where the market is going, so please stop believing in other people's signals. It's better that you learn how to trade yourself and learn how to make a good decision when you trade. So by that, I end my presentation here. This is not the end. This is just the beginning. So let's keep in touch. You can find me here in all these social media. This is our brand, TFS Price Action Trading. You can find my name, Khalid Hamid, in Facebook as well. If you do find this presentation helpful and beneficial, please do share this video to your friends and fellow traders. If you have a feedback to share about this video, if you have any question, you can comment on the video or you can email to us at info@tfspriceaction.com. At the moment, our trading course is only available in Bahasa Malaysia. You can find it here at tfspriceaction.com. However, starting 2013, actually, I've been really wanting to have a course in English. And now, since that we have done our branding and also our latest trading course, I believe it is time now for me to teach in English more seriously. So if you enjoyed this video, I definitely guarantee that you will like the course later on that we will do. I hope to finish the course by the end of 2018 and you will be the first to know. You just need to subscribe to me for me to send up to you all the latest news. So again, if you really like the video, don't forget to share this video with your friends and fellow traders. Until then, thank you so much for your time and really hope that you enjoy the video and learn a lot of valuable lessons in it. Last but not least, all the best in your trading career. Okay, bye bye. See you in the next video. Thank you.